Welcome to Breaking News to Trading Moves. Today we're looking at a piece of news that has definitely caught the market's attention, especially in the healthcare space.
That's right. We're talking about a warning that came from UnitedHealth Group, a pretty pointed one, actually, about their revenue outlook for 2026.
And it's the context that really makes you stop and look. The company is signaling that it might see its first revenue drop since 1989.
1989, I mean, that's a long time. It covers multiple recessions, different administrations, healthcare reform. A lot has happened in that time.
It really has. So for them to flag a potential drop now, it tells you something about the environment they're looking at.
It absolutely does. It suggests the headwinds are stronger than anything they've faced in, well, decades.
So we have to figure out what is the driver here, what's causing this much concern.
And the report is very clear on that. It points to one main catalyst, and that is the government's proposed 2027 rate increase for Medicare Advantage plans.
Okay, and the term they're using is near flat.
Near flat. And you have to be careful with that term because, flat might sound okay, it sounds stable. But in this industry, with medical costs constantly rising, flat is. Well, flat is a problem.
Right. It's like your own salary being flat while all your bills are going up. Your personal profit margin is getting squeezed.
That's the perfect analogy. And the market has a sort of equation for this, which the text lays out. It's reimbursement pressure. That's the flat rate, plus higher medical costs.
And that equals?
That equals margin squeeze risk, a big risk. And it's aimed squarely at the insurers who have a lot of their business tied up in Medicare Advantage.
So that's our focus today. We're going to break down the winners and the losers that come out of this one news item, this one warning. We'll look at who gets hurt and, importantly, where that money goes when it leaves those stocks.
Exactly. We'll start with the direct impact, the losers, and then trace the capital rotation to see who benefits.
All right, let's get into it. First up, the most obvious group, the losers. And the first category is what we're calling the Medicare Advantage-heavy insurers.
These are the companies right in the crosshairs. The news is about them specifically.
So walk us through the mechanics of it. How does a single near-flat rate proposal from the government cause such a problem that these huge companies have to completely rethink their operations?
Well, the whole business model is built on a set of assumptions. One of the biggest is that reimbursements will, at least keep pace with the rising cost of care.
That the money coming in will grow alongside the money going out.
Precisely. When that core assumption breaks, the math just doesn't work anymore. They can't offer the same product for the same price if their funding gets cut effectively, so they're forced to make changes.
And the text points to a few specific consequences. First one is benefit reductions.
Right. And that's one of the main ways these Medicare Advantage plans compete. They offer perks that traditional Medicare doesn't, things like dental coverage, vision, hearing aids, gym memberships.
The extras that get people to sign up.
Exactly the value adds. When the margins get squeezed, those are often the first things on the chopping block. The insurer might have to say, okay, for 2026, the dental benefit isn't as generous, or we have to pull back on the fitness program.
Which, of course, makes the plan less attractive to new members and maybe even makes current members think about switching.
It does. It's a direct hit to their competitive position.
Okay, the second consequence mentioned is narrower footprints. What does that mean in practice?
This is about geography. Think about it. An insurer like UnitedHealth operates in thousands of different counties, and the cost of healthcare isn't the same everywhere.
Sure. A procedure in New York City is going to cost more than one in rural Nebraska.
Exactly. So the insurer looks at their book of business county by county. They might find that in, say, Dade County, Florida, the local hospital network charges really high rates and the population has higher healthcare needs.
So their costs in that specific area are really high.
Very high. And if the government's reimbursement rate doesn't account for that local reality, the insurer could be losing money on every single member they have in that county.
A rational business can't do that for long.
They can't. So a narrower footprint means they make a business decision to just pull out. They won't offer their Medicare Advantage plan in that county next year. They shrink their map to protect their profitability.
And the last point was tougher pricing decisions.
This one is pretty straightforward. If the government isn't giving them enough money on one side, they might try to get more money from the other side, the member.
So they raise the monthly premiums that the seniors have to pay.
They might have to, yes. Or increase copays. Or raise deductibles. Any of those levers passes more of the cost onto the consumer, which, again, makes the plan less attractive.
So all three of these things, cutting benefits, shrinking their footprint, raising prices, they all lead to the same financial outcome mentioned in the report, a risk of slower earnings growth and margin compression.
That's the bottom line. If your product is worse, you grow slower. If you shrink your business, you grow slower. And if your costs are still rising faster than your revenue, your margins get crushed. It's a tough spot.
Okay, so let's put some names to this, the specific tickers that fall into this loser category.
Well, we have to start with the one that kicked this all off, UnitedHealth Group.
Ticker is UNH.
Yep, UNH. As the company that actually issued the warning, they're ground zero for this whole discussion. They are explicitly telling the market that the setup for 2026 and beyond is looking difficult.
So they are the primary example. Who else gets lumped into this category of being MA heavy?
The other big name that always comes up here is Humana.
HUM.
HUM, correct. Humana's business is even more concentrated in Medicare Advantage than UnitedHealth's is. It is the core of what they do. So if there's a headwind for the MA industry, Humana is going to feel it very, very acutely. They're highly susceptible to all those risks we just talked about.
So UNH and HUM are the big direct losers here. But the impact doesn't stop there.
No, it doesn't. That brings us to our second category of losers. Diversified insurers with meaningful exposure.
So these are companies that do more than just Medicare Advantage, but they still have enough of it that the market is concerned.
That's the idea. And the logic here is really about how the market reacts to bad news. Even if a company is diversified, they have commercial insurance or pharmacy business, whatever, when a specific part of the business gets hit with bad news, the market tends to focus laser-like on that one problem area.
It prices the risk of the Medicare Advantage book or portfolio first and asks questions about the rest of the business later.
Exactly. And the text makes another good point. This is especially true if medical cost ratios are already trending higher. If costs are up across the board, the market gets even more nervous about the part of your business where reimbursements are now flat. The problem looks even worse.
Okay, so which companies fit this profile?
The first one that comes to mind is CVS Health.
Ticker is CVS.
Right, CVS. Most people think of CVS as the corner drugstore, but a few years ago they bought Aetna, one of the biggest insurance companies in the country.
And Aetna has a huge Medicare Advantage business.
A substantial one, yes. So even though CVS has this massive retail footprint and a big pharmacy benefit manager business, this news about MA rates directly hits the earnings power of their Aetna division. In this environment, the market sees the Aetna risk as a drag on the whole company.
So the stability of the drugstore side isn't enough to offset the new uncertainty on the insurance side.
In the near term, that's how the market is looking at it. The negative news is outweighing the stable parts of the story.
And who's the other company in this diversified bucket?
Elevance Health.
That's ELV.
Elevance is another one of the giants. They have a very large and successful commercial insurance business serving employers. But a key part of their growth story for investors has been their expansion into the government space, including Medicare Advantage.
So the market is now reevaluating that growth story.
Precisely. If the government business, which was supposed to be a growth engine, now looks like it's going to be a source of margin pressure, the whole investment thesis for the stock gets questioned. That's why a name like ELV sells off along with the more concentrated players.
Okay, so that's two more for the loser column. CVS and ELV. Now, there's a third category here which is a bit different. Smaller or high beta managed care names.
High beta is just market speak for stocks that tend to be more volatile than the overall market. When the market is up, they're up more. When it's down, they're down more.
So what's the logic for why these names get hit particularly hard in this scenario?
The text describes the current mood as a rates plus medical costs scare. And in that kind of environment, investors tend to de-risk. They sell their most volatile holdings first and move toward what they see as safer assets.
They hit the sell button on the smaller, more speculative names the hardest.
That's it. It's a flight to quality, or at least a flight away from perceived risk. The mechanism behind it is that the risk premium for the entire sector goes up. Investors demand a higher potential return to compensate for the higher uncertainty, and that weighs most heavily on the smaller companies that may not have the fortress balance sheets of a UnitedHealth.
It's the old saying, when the tide goes out, you see who's been swimming naked.
A bit like that, yes. Or if the elephant stumbles, the mice nearby get nervous. The market assumes that if an industry giant like UNH is warning about a tough environment, it must be borderline impossible for the little guys to navigate.
So who are the tickers that fit this high beta description?
One example given is Oscar Health,
Ticker OSCR.
OSCR. Oscar is a newer, more tech-focused player. They're still in a high-growth phase, maybe not as consistently profitable as the established players. They have less room for error. So in a negative news cycle for the industry, a name like Oscar can react very sharply to the downside.
The market's patience for their growth story wears thin when the whole industry is facing a margin squeeze.
Right. And another name that fits this profile is Alignment Healthcare.
ALHC.
ALHC. Similar story. A smaller capitalization, a higher beta. They're very focused on Medicare Advantage, but without the scale of a Humana. This makes them vulnerable when sentiment turns negative on the whole sector.
So to sum up the losers, we have the MA-heavy giants, we have the diversified players that get dragged down by their exposure, and then we have the smaller high-beta names that get sold off in a general de-risking.
That covers the negative side of the ledger pretty well, but as you said, that capital has to go somewhere.
Right. It doesn't just disappear. Let's talk about the winners. Where does the money rotate to?
Okay, so we have three main categories of potential winners as well. The first is what we can call managed care, with lower sensitivity.
So staying within the same neighborhood but moving to a safer block.
That's a great way to put it. The logic is that when investors want to reduce their specific Medicare Advantage risk, they don't always flee the managed care sector entirely. Instead, they rotate within the sector. They sell their UNH and HUM and buy other insurance companies that are more skewed toward different lines of business.
And which lines of business are considered safer in this context?
Primarily Medicaid and commercial. These areas are viewed as less directly impacted by the specific Medicare Advantage rate proposal.
Let's break that down. Why is Medicaid insulated?
Well, Medicare is a federal program primarily for people over 65. The rates we're talking about are set by the federal agency, CMS. Medicaid, on the other hand, is a joint federal-state program for low-income individuals. A lot of the rate setting and administration happens at the state level.
So a near-flat rate notice for the federal Medicare program doesn't automatically mean that rates in, say, the Texas or California Medicaid programs are also going to be flat.
Exactly. They are largely decoupled. So if you're an investor, you can sell a stock with federal rate risk and buy one with state-level rate risk, effectively diversifying your regulatory exposure.
Okay, so who are the beneficiaries of that rotation?
The classic example is Centene.
CNC.
Centene is by far the biggest player in the Medicaid space and also on the Affordable Care Act exchanges. Their business is heavily weighted toward these other government programs, so they're seen as having much lower sensitivity to this specific piece of Medicare Advantage news.
So money flows out of HUM and into CNC.
That's the rotational trade. And another company that fits this mold is Molina Healthcare.
MOH is the ticker.
MOH. Molina has a very similar business profile to Centene, just on a smaller scale. They are very heavily skewed toward Medicaid. So in this environment, a stock like Molina becomes a relative safe haven for investors who want to stay in managed care but dodge the MA bullet.
So CNC and MOH are the winners from that intersector rotation. What's the second category of winners?
The second category is for investors who decide to leave the insurance subsector altogether but want to stay within the broader healthcare world. We call them defensive healthcare rotation beneficiaries.
Okay, and what's the logic for where they put their money?
The idea here is that when you get scary headlines about policy or reimbursement hitting the insurers, capital flows toward what are seen as durable, large-cap franchises. The key criteria, as the text notes, is that their demand is driven by things like product cycles and demographics, not by Medicare Advantage rate math.
So you want a business whose success isn't tied to a specific government reimbursement formula. You want something driven by innovation or a fundamental, unstoppable trend like an aging population.
You've got it. You're looking for businesses with more control over their own destiny.
So who fits that bill?
One of the classic defensive names in all of healthcare is Johnson & Johnson. J&J. It's almost the definition of a defensive healthcare franchise. They're huge, they're diversified across pharmaceuticals, medical devices, and historically consumer health. The demand for their products, like, say, a device for a knee replacement, is driven by demographics and aging population. That need exists whether the MA rate is up 2% or down 1%.
That demand is less elastic. It's driven by a medical need, not a policy decision.
Yes, and the other big name mentioned is Eli Lilly.
Ticker LLY.
LLY. And Lilly is a perfect example of the product cycle driver. Their fortunes right now are being driven by a portfolio of new, Innovative drugs, particularly in areas like diabetes and weight loss,
The GLP-1 drugs that we hear so much about.
those are the ones. The demand for those products is absolutely enormous and is completely independent of the Medicare Advantage rate notice. So an investor might look at the uncertainty around UNH and say, I'd rather own the growth story at LOY, which is driven by their own R&D successes.
So J&J and LOY become the safe harbors for capital leaving the managed care space.
That's the thesis.
Okay, that brings us to the third and final category of winners: healthcare cost and efficiency enablers.
This one is a little more indirect, but it's a really important part of the story. It looks at the systemic reaction to the pressure we've been talking about.
And the logic is, if insurers are getting squeezed, they are going to squeeze their providers, the hospitals and doctors, even harder.
Yes. If insurers tighten benefits and push harder on what's called utilization management, basically approving or denying care, the whole healthcare system is forced to become more efficient. The payers, the insurance companies, have less money, so they push the providers to do more with less.
And in that kind of environment, who wins?
The big guys. The large operators are seen as being much better positioned to handle this kind of pressure than their smaller peers. In a world of reimbursement volatility, scale becomes a huge advantage.
Because they have the ability to manage patient throughput, negotiate better contracts with their own suppliers, and generally control their costs better.
All of the above. They can invest in technology and processes that a small community hospital just can't afford.
So who are the tickers here?
The prime example is HCA Healthcare.
That's HCA.
HCA. They're the largest for-profit hospital operator in the country. They have unmatched scale, they can manage costs, manage their staffing, and negotiate with insurers from a position of strength that smaller hospitals don't have. So, in a tougher reimbursement world, the market bets that HCA will not only survive, but will likely gain share.
They're seen as an efficiency winner. And the other one,
A similar name is Universal Health Services.
UHS.
UHS, another very large, well-run hospital operator with the scale and the systems to handle the pressure from the payers. They're also seen as being a beneficiary when the system is forced to lean into efficiency.
So HCA and UHS are the winners because they are best equipped to operate in the new, tougher world that the insurers are creating.
That's the logic of the trade.
Okay, this gives us a really clear map of the winners and losers. Before we wrap up, we should touch on what to watch for next. What are the upcoming signals that will tell us how this story is evolving?
There are a few key indicators, yes.
The first one seems to be the most important: the regulatory milestone.
Absolutely. We have to watch for any updates to the final 2027 Medicare Advantage rate. Remember, what UnitedHealth was reacting to was a proposed rate. There is a comment period, the industry lobbies, and then a final rate is published.
And that final number can be different from the proposal.
It often is. Usually it gets adjusted slightly upward. So if the final rate comes in a little better than near flat, you might see a relief rally in some of these losing stocks like UNH and HUM. If it comes in the same or worse, it confirms the negative thesis.
So that final notice is a huge catalyst. What about operational metrics?
Here, you want to listen closely to what the companies say on their earnings calls about medical cost trends. There are three key components to watch: utilization, pricing, and mix.
Let's quickly define those. Utilization.
That's just how much healthcare people are using. Are they going to the doctor more? Are they having more surgeries? A really bad flu season, for example, would drive utilization up. That's what providers are charging. Are hospitals demanding higher price increases in their new contracts?
And mix.
That's about the types of services being used. Are people getting more complex, expensive surgeries versus routine checkups? All three of those things drive the insurer's costs, so we need to monitor them closely.
Right. And then there are the strategic responses from the insurers themselves.
This is where the rubber meets the road. We need to watch to see if insurers actually start to pull back benefits or, more dramatically, announce that they're exiting specific geographies.
So we'd be looking for a press release from Humana saying, we will no longer be offering plans in these 20 counties.
Exactly. When that happens, it's no longer a theoretical risk, it's a reality. And it confirms the pressure is real.
And the last indicator is peer signaling.
This is crucial. We heard from UnitedHealth. Now we need to listen to what their peers, Humana, CVS, Elevance, say when they report their earnings. Do they echo the warning? Do they say, yes, we agree, 2026 is looking tough?
Because if they all start saying the same thing, it confirms this is a sector-wide problem, not just a UNH problem.
Correct. But if for some reason they came out and said, actually, we see things differently, we think we can manage through this, then you might see the market start to differentiate more between the players.
But based on how the stocks have all moved together, it seems the market is betting they're all going to sing a similar tune.
The market is definitely assuming this is a broad-based issue, yes.
Okay, let's try to bring this all together. What's the final thought for our listeners?
I think the central theme here is just the tougher operating setup that UnitedHealth has flagged for 2026 and 2027. The easy growth days for Medicare Advantage might be behind us, at least for a while.
And the open question that you, the listener, should be thinking about is this. As these insurers navigate this very real margin squeeze, the entire industry will be watching to see exactly how they respond. How deep are the benefit cuts? Which specific towns and counties see plans disappear? The answers to those questions will shape the healthcare landscape for millions of people.
That is the key dynamic to watch unfold.
And before we close, I just need to read our standard disclaimer. This conversation is not financial advice. We're not providing buy or sell recommendations for any security. This is purely for informational purposes and represents the opinion of the author.
That's right. Please do your own research.
Let's just quickly recap the tickers one more time just for clarity.
Good idea.
In the losers camp, in Category 1, the MA heavy names.
That was UnitedHealth Group, UNH, and Humana, HUM.
Category 2, the diversified players with exposure.
CVS Health, CVS, and Elevance Health, ELV.
In Category 3, the smaller, high beta names.
Oscar Health, OSCR, and Alignment Healthcare, ALHC.
Okay, now for the winners. Category 1, the managed care names with lower sensitivity.
That would be Centene, CNC, and Molina Healthcare, MOH.
Category 2, the defensive rotation beneficiaries.
Johnson & Johnson, J&J, and Eli Lilly, LLY.
Then finally, Category 3, the efficiency enablers.
The big hospital systems, HCA Healthcare, HCA, and Universal Health Services, UHS.
That's the list. It really lays out how a single government rate proposal can set off this chain reaction across the entire healthcare ecosystem.
It connects everything from a regulatory filing in Washington, D.C., all the way to the stock prices of a dozen different companies.
An amazing illustration of how interconnected this all is. A lot for investors to track.
It is. The key is understanding the mechanics behind the moves.
I think we've laid out a pretty good map of those mechanics today.
Hopefully it gives everyone a framework to watch this story develop.
Thank you for listening to Breaking News to Trading Moves.